Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. I am excited for this episode. How can you not be excited when the US cut rates?
Yeah, well, congratulations to the US.
We're living in utopia. Everything's solved. No, look, we spoke about the US rate cut in the last episode, but as expected, the US cut rates, life goes on.
Life goes on.
Inflation ticks higher.
Yes.
But that is not what we're talking about today. We're going to talk about some individual companies that have captured our attention. We're back with another episode of Pimp My Portfolio. Matt Ingram is back in the studio reviewing the portfolio of an Equity Mates community member. And we're closing out with Super September. Our month that we try and get Australians to think about their super continues. And today we're talking all things voluntary contributions.
News and markets.
The headlines we're covering this morning, Ren, Larry Ellison's historic run and who he is, because he's had a phenomenal past. Well, you could argue probably 2025.
You could argue 50 years.
Yes, that is very true. That is true. Let's start with Larry.
I reckon you would say Larry Ellison's last week has been the best week in business history.
Wow. On what metrics?
Well,
Let's get into it.
Okay.
Let's get into it. First, we should just start with who Larry Ellison is. So Larry Ellison is an 81-year-old American businessman. He co-founded Oracle in 1977 after getting a CIA contract to build a database system, which became the company's founding product and namesake. So Oracle is the database software platform that they have created.
Yeah, and Oracle became one of the big software giants of the early, I guess, internet era, and they made a lot of business software, enterprise management, business database software. That's what they were known for. Big server rooms, go and install their software, and that's what Walmart runs their enterprise management, their HR systems and stuff off.
So Larry's been ran the business for nearly 50 years, serving as their CEO. In 2014, he became their chief technology officer and chairman.
Yeah, he took a step back.
He took a step back, and so for the last sort of decade has been running. Well, he's still the face of the business.
He's always floated around that sort of top 10, top 20 world's richest people. More recently, he's sort of pushed back into the top 5.
Yeah.
That's Larry Ellison, pre the AI story. The AI story is where Larry Ellison's historic run starts, because really over the past 18 months, Oracle has been pushing more and more into data centers, cloud computing, and AI. And in particular, Oracle's proposition, it's called like multi-cloud computing. And essentially there are 3 hyperscalers that we talk about when it comes to data centers. Amazon Web Services, Microsoft Azure, and Google Cloud. And Oracle offers this multi-cloud product where you can use all of them through an Oracle system. And so that has just gone gangbusters. They've been providing compute for a lot of these AI applications. They're building data centers themselves, and that has been a massive boon to Oracle. It's been a massive boon to their share price, and as a major shareholder in Oracle, who's actually been increasing his shareholding because Oracle has bought back a lot of stock over the years, and I think he's even bought more over the years. It's been a massive boon to Larry Ellison's net wealth.
Yeah, well, that's where the story really starts for one of the greatest weeks, as you said, in business history, because he added nearly $100 billion to his net worth in a single day, briefly overtaking Elon Musk as the world's richest person with a fortune close to $400 billion.
Yeah, it depends which. Bloomberg and Forbes disagreed, but by some measures, he still is the world's richest person.
So the boost came after Oracle's shares jumped 35% in one day. Now, that came about from their earnings report. A phenomenal earnings report which had forecasts for future revenue that just absolutely blew Wall Street's top off, really.
Yeah. So there were two big numbers. The first was three. The first one was that they announced in the quarter they had signed 4 multi-billion-dollar contracts for this cloud computing part of the business. The second was that their order backlog had spiked like 355% or something massive like that. And then the third one was a projection that they gave for their future cloud revenue, which was currently at about 18 billion, and they projected it to get to 144 billion over the next 4 years.
Bang.
And so all those numbers, everyone got very excited about the possibilities, and the share price absolutely ran up.
Yeah.
And then that frenzy was amplified when it came out like a day or two later that one of these big contracts was with OpenAI.
Yeah.
It was a $300 billion contract. Now, important to stress, OpenAI doesn't even have $300 billion.
Yeah.
They're going to need to raise money. Larry Ellison's going to participate in that capital raise. But anyway, that's a rabbit hole we won't go down.
Yeah, look, so the stock was up 47% in the space of about 2 or 3 days. It's up over 80% in 2025, outpacing some of the big tech giants. So incredible week there, but that's not all that he's been involved in the last week. Let's move to the news around TikTok, which he is deeply involved in because Oracle is leading a US investor group.
We'll take a step back. So for people who've been following this story, TikTok was meant to be banned in the US January 2025.
Yeah.
The Trump administration has kicked that can down the road 3 times as the US and China negotiate and TikTok lobby hard. Do you remember when they blacked out TikTok for a weekend?
Yeah.
The 170 million US users were not happy.
Yeah.
That put pressure on. So anyway, TikTok has been allowed to operate this year, even though Congress and the Supreme Court have said it needs to be sold or banned.
Yes.
US and China trade negotiators have been trying to work out a deal, and we got news that negotiations in Spain had led to an agreement.
Yes, and there is rumours, well not rumours, but Oracle is very much in the mix here.
Yeah, so the Wall Street Journal reported that it will be a consortium of US companies that will be buying TikTok's US operations from ByteDance.
Yeah.
So Oracle, Larry Ellison's company, will be leading the consortium alongside Silver Lake and Andreessen Horowitz. Silver Lake is a big private equity firm. Andreessen Horowitz is a big venture capital firm. All of ByteDance's US shareholders will retain their shareholdings in TikTok US operations. And importantly, ByteDance, the Chinese owner of TikTok, will retain 19.9% ownership, and the US consortium will be paying ByteDance to license the algorithm. So the ByteDance, the Chinese company, will still control the algorithm.
So let's turn to Hollywood, where the story continues for the Ellisons because Larry is helping his son David, who's a producer, continue his push into Hollywood. So the story is that they have they've already bought full control of Paramount Global, and now they are preparing a bid for Warner Brothers Discovery. So they're getting deep in media. The acquisition of Paramount Global, obviously pretty momentous, but since then they've also outbid Netflix for exclusive rights to the UFC in a record 7-year deal. They've signed the creators of Stranger Things away from Netflix for upcoming films, and they've acquired streaming rights to South Park for $1.5 billion. So really pushing into media.
So someone made the point that as David Ellison sort of takes over Hollywood, there's an argument that what they're going to try and use the TikTok algorithm and some of the learnings from TikTok to fuel their sort of Hollywood strategy. So there might be an interesting tie-up there. So obviously 3 massive stories there. One completely tied up with the AI story, Oracle, then the biggest deal of the year if it happens, the TikTok story, and then the changing nature of media and entertainment in Hollywood. And Larry Ellison seems to be in the middle of all of them, all in the space of about a week. So watch this space.
Love it. Well, if you'd like to keep up with all the news here at Equity Mates, make sure you subscribe to our daily newsletter. We'll put a link in the show notes. We summarize all the news headlines for you and send it straight to your inbox, 6 a.m. every day. Welcome back to Equity Mates. It is time for...
Pimp My Portfolio. Pimp My Portfolio.
We have a community member on the line who has submitted their portfolio for our expert in the studio to review and provide some ideas on how to improve it. So firstly, the expert with us today is Matt Ingram from North Haven Financial Management. How are you, Matt?
Yeah, good, thank you.
And on the line, submitting their portfolio, taking one for the team, is Kin. Kin, how are you?
Hi, I'm good. Thank you.
Kin, before we get stuck into it, can you just introduce yourself?
Sure. So I've been in Australia about 5 years now. I had to restart my financial journey from scratch a few years ago. So it's a fairly new portfolio that I have. I'm fairly new to investing, and you guys have been mostly what I've been listening to in terms of learning. So if I've made mistakes, I'll blame you.
Well, I'll introduce the portfolio and then we'll get Matt to give it a nickname. So to start with, it's about 40% in ETFs. Some of the big names are in there: Vanguard or VDHG, the Vanguard Diversified All Growth, DHHF, Beta Shares Diversified All Growth, Vanguard International Shares, S&P 500 by iShares, and S&P 500 by SPDR, and the NASDAQ 100. A couple of thematic ETFs, Beta Shares Global Healthcare, Global Cybersecurity, and FANG Plus. Then if we get to individual shares, we've got a couple of Aussie shares to start things off: Commonwealth Bank, BHP, and then we've got US shares: Nvidia, Alphabet, Snowflake, Meta, Walt Disney, and Apple. And then to close it out, so we had 40% in ETFs, 30% in stocks, just shy of 30% in crypto, Bitcoin and Ethereum, and then a tiny bit of Solana. Interested to hear what Matt thinks about that. So, Matt, let's kick it off. We'd like to start with a nickname. What have you got for us today?
Not to go on a tangent, but there's this, I can't remember if it's an ad or like a short film or whatever, but they're at like a pub and everyone is saying like, oh, that's un-Australian. And when they say that's un-Australian, that thing like just goes like poof, disappears. And they all end up saying like, oh, that's and everything ends up disappearing, with the whole thing being like everything's un-Australian and nothing's un-Australian. But it just reminded me of this because there's no ASX 200 ETF. So I'm calling it That's Un-Australian.
Okay.
Wow, what a wind up. So, Kin, why don't you, you mentioned there that you'd sort of started your financial journey from scratch 5 years ago. So sort of talk us through how you've built the portfolio, and then I think, how you're investing going forward at the moment.
So it's a very much a crawl, walk, run situation. Rather than sitting on the sidelines and waiting till I knew everything, I started by getting money into the market while learning the ropes. Then I moved to the next phase and tested out ETFs, buying into themes that I believed in. I work in technology, so that's where all the tech stocks are coming in from.
Nice.
So I'm at the point right now where I'm somewhere in between walking and running. So I'm DCAing into IVV consistently, picked up a few stocks and maxed out my super contribution during the Liberation Day dip.
Nice.
And now I'm starting to think about structure and longevity. So my goal is to build a solid nest over the next 10 years so I can gradually ease out of my current tech job and shift into a different lower paying profession, which is more aligned with the lifestyle I want long term.
Love that. Love that. And so then going forward, you're DCAing into IVV and then I guess opportunistically buying sort of the thematics and the ET and the individual stocks?
Yes, so that's where I'm at right now. And if you look at my portfolio, basically what I want to know is how should I be thinking about balancing growth and stability? Because if you look at the portfolio, the individual stocks have performed way better than the ETFs. Even the thematic ETFs have performed better than your IVVs and SPYs.
Kenneth, you're too good a stock picker. You're too good an investor.
Yeah. Well, obviously all learn from equity. Right?
Yeah, we'll take credit for that.
One more is that I've got some money sitting on the sidelines and I don't know what to do with it. So just wanted to get your understanding in how would you suggest deploying that in today's environment.
Nice. All right, Matt. Well, let's start high level. Firstly, just general thoughts on the portfolio and its construction.
Yeah, so first things I notice are that there's a lot going on in that core. It looks like there's been a bit of a change of strategy or approach a few times. And Kin, I think that just comes down to, you said you didn't want to wait to start. You just wanted to make a start, which I think is actually quite good. Analysis, paralysis, all of that kind of stuff. It's very real and people can spend way too long trying to figure out what's the best approach before even doing anything. So well done on just getting started. The other thing that jumps out is the heavy allocation to US tech names in the direct part of the portfolio. So that's probably why you've done so well, is because they've done so well. Might not always be the case. So the ETFs might have a time where they do better than the direct names. That can change. With the core, So you're adding into IVV, but you've already got quite a bit of US direct. You've got quite a bit of US in your international shares ETF. I think a better approach for the core would be to dollar cost average into VGS, where you're going to get that US exposure and some other exposure. And then I would want to say to DCA into the Aussie market as well, because there's just not, well, there's no Aussie ETFs in here at the moment, but you've got big holdings in CBA and BHP, which is a huge part of the ASX 200. So to avoid overlap, you can actually get an ETF now called OZXX, which strips out, it's the ASX 200, and then it strips out the banks and resources. So because you've already got banks and resources fairly concentrated, just CBA and BHP, but they are, the big players, maybe think about you DCA into VGS and OZXX, and that will give you a bit of Australia, but also some international, nice, broad-based, everything else.
What are your thoughts on that, Kin?
That sounds good. I'd not heard about OZXX yet in your podcast.
No.
So, new one for me. VGS is something that I have been thinking about as well, but I had not thought of increasing that in my core or continuing to DCAing in it. But what you're saying is absolutely making sense because it is heavily focused on US stocks right now. So definitely VGS seems like a better idea.
And so, Matt, when you have clients like Kin come in who say, look, I've got a horizon here of 10 to 15 years, at which point I'm then going to want to rely on a portfolio to substitute some income and I don't have to, rely so heavily on a paycheck. How do you think about the allocation to sort of growth versus that sort of income at a stage like this where you're still not needing the income right now?
Yeah, I would still be focusing on growth just because things can change and time might pass and you might want to keep working. And then if you spent that time focusing on income, you've lost out so much on potential growth. So I would still keep a growth focus. There'll be a time where you'd have to transition into more of an income focus and there might be a bit of tax to pay at the time. But yeah, while things are still a fair way out, 10 plus years, keep the focus on growth for sure.
Nice.
Well, while we're talking about growth assets, let's talk about the just shy of 30% of the portfolio that's in crypto. As a financial advisor, I'm sure you're getting questions constantly about crypto allocations. So what do you think about this one?
Yeah, that's a pretty heavy allocation. That is, good 29%. Yeah, look, if you're just particularly keen on crypto, I understand why you'd do that. Some people just love crypto, but I don't know that you necessarily need that much. I would broaden it out, treat crypto a bit like another one of your other holdings, maybe 5%. You could do a bit more if you're really into it, but I would say a third of the portfolio in crypto. If this is going to potentially be a replacement for your income one day, and crypto doesn't pull its weight and perform that well, you could be jeopardizing those future plans a little bit. So definitely some to get that growth, and if it does do well, you'll feel it, but I don't think you need 28%.
Are you particularly bullish on crypto, Kin, or is it just because you got in at great times and both of these, Bitcoin and Ethereum, have just run pretty hard?
That's exactly what it is. I made some good gains. That was my first investment. I exited the market and then FOMO and got back in. Again, made good gains. So I'm in here just for the next couple of, I think I'll definitely be selling it off in the next high.
Jeez, you're sounding like you know what you're doing.
Jeez, that podcast that you're learning from must be really
First
good.
investment, nailed it, sold out, got back in.
Yeah, if that's the case, Ken, and you're not adding to it. Yeah, if you're not adding to it, then just it. I mean, unless it grows faster than everything else, it might always stay as 30%. But if you just keep dollar cost averaging into the core and some other satellites, then hopefully over time it'll balance out.
Yeah. One question that Kin had was around taking a lump sum and allocating it into this portfolio. How would you approach a question like that?
Yeah, we talked about this recently in terms of where you might think of doing it. Depends on the size of the lump sum. If there's enough to distribute between the core as well as some satellite holdings that you're keen on at the moment, then you could do that. When I say is there enough, you don't want to be putting, tiny amounts across everything and then paying more brokerage than you have to and eating away at your returns by doing so. So, I mean, if there is enough, you could just fill out the core a little bit, maybe start that OZXX holding to balance that out a bit with VGS. And then if there's any, I wouldn't be adding to these US direct names right now. Some of the smaller ones look okay. Disney looks okay. You could think about doing that. But I mean, NVIDIA's gotten big probably because it's run hard as well. Google's getting pretty big. So if you want some more names, but really what jumped out actually is the thematics in this. It's not that often that you see someone that has a few different thematics in the portfolio. They might have heard of, hack or something and thrown it in there. To see you actually, taking those thematics quite seriously, I think is quite a smart play. You could treat them a bit like a satellite. You want exposure to a particular theme. You don't know who the best player in that space will be. And so you just buy the thematic. I think that's really smart. So potentially topping those up, probably not FANG, given that you've got some big US tech names in there, but drug, hack, there's a bunch of other thematics that if you have a look at them, have a think about it, do you think they'll do well over time? Those are the kinds of things that could definitely outperform the broader market.
Nice one. Well, Kin, I think there's a lot to like here. While you've got Matt on the line, did you have any other final questions for him?
How do you think about DHHF? I know we've spoken a lot about that ETF on the podcast, but in terms of growth, it's been a bit up and down. So do you think that's an ETF that I should be looking at as well?
I think keep it, but you sound like the kind of person who's pretty switched on, having a pretty good crack at this. I wouldn't call, a VGS and OZXX portfolio being overly active, but it's a bit more active than DHHV in that you can balance the weightings a little bit, and you sound like you'd be very capable of doing that. So I would probably just leave it for now, let it keep going, but probably don't worry about adding to it. You've got the knowledge to make a few more moves beyond that.
Yeah, I think to add to what Matt's saying, DHHF and VDHG, they're kind of like the all-in-one portfolio. So if you're building your core yourself, you don't need to do both.
Yeah.
So it's like, you choose one path or the other. No path is the wrong path. Like at the end of the day, the portfolios are going to look very similar. It's just if you want a bit more control. But I think we've asked Matt this before on another Pimp My Portfolio episode where there was some overlap and we asked Matt if we should be selling those positions, and as long as you're happy to see them in your portfolio, then perhaps you leave them there because you don't want to incur the tax liability.
Yeah, it's all going to do more or less the same thing, and if you're doing it just to purely clean it up, well then just consider that you're probably going to pay some tax to do that. The only one that I probably would get rid of is that fund in there, the Vanguard Growth Index, which is such a small holding anyway. You could dump that and add it to the rest of the core. But those broad-based ones, might not be worth tidying it up because you're going to pay tax anyway. It's going to do much the same thing as your core.
Absolutely agree to that. Thank you so much. This has been such a helpful conversation.
Well, we're glad, Ken. Thank you so much for submitting. We do really appreciate it. We know it's not easy putting your portfolio up for scrutiny from an expert. So it sounds like you're well and truly on the right track, though, and all the best for the next 10 years.
Oh, thank you so much. And that's brilliant validation. I'm feeling really proud right now. Thank you.
That's good.
Nice one,
That's
Ken.
good.
Well, we're glad and well done. And hopefully we can keep helping you on the journey.
Thank you.
And Matt, thank you as always. We really appreciate you giving your general advice to the listeners that come on.
Yeah, thanks guys.
If you'd like to submit to Pimp My Portfolio, head to equitymates.com/contact and fill in the form there. If you'd like to speak to Matt or any of our other advisors, you could head to equitymates.com/advice, fill in the form, and we'll connect you with the most appropriate advisor for you. Bren, Super September continues here at Equity Mates. It's the month where we ensure all Australians are paying attention and engaging with their super fund, the biggest free kick in finance, potentially the largest chunk of assets you will have later on in life outside of your home. So the important thing is that you pay attention to what is going on. And today we are talking all things voluntary contributions.
Yes. And so we're going to talk about how simple it is today, how everyone can take advantage of it, and what the effect could be. We're also going to answer a question that has come through from a listener. But before then, we want to say a massive thank you to Vanguard Super for supporting Super September and helping us keep all of our content free.
That's it. You should be choosing a super fund that works as hard as you do. Vanguard's lifecycle investment option has delivered a 13.55% annualized return since launch for members aged 47 and under. Head to vanguard.com.au/super to explore Vanguard Super.
Products issued by Vanguard Super Pty Ltd. Consider the PDS and MD at vanguard.com.au/super and decide if it is right for you. Past performance is not a reliable indicator of future performance. Performance annualized from the 5th of October 2022 through to the 30th of June 2025. Investment returns are not guaranteed.
We're loving that Equity Mates community are engaging with Super September in our Facebook page and sending questions in. And today's question around voluntary contributions comes from Matt.
Hi lads, love the podcast. I've been listening for well over a year now after finding one of your books one day, about a year and a half ago, and I can't get enough. I've got a question for Super September. I'm now 46. I have about 450,000 K in super, but I've always had the balanced option as a default. Should I be looking at going for high growth now, as I still have a fair way to retirement, or stick with what I have? Also, I'm currently putting away roughly an equal amount into super with salary sacrificing, and as well into the stock market with 4 core ETFs. Is this a sound strategy for someone my age? Love the work, lads. Thanks.
Love it. Well, thank you so much for the question, Matt. Now, of course, we don't know your personal circumstances, so we'll answer this in generalities. Is that right? Generalities?
Yeah.
I think just to quickly address the first part, which is balanced versus high growth. I mean, he's saying 46, so there's still a long time horizon until you get to the age of being able to touch your super. So I would still be personally getting towards the higher end of the, I guess, a growth portfolio than not at that point in my life.
Yes. Yeah, I think that's generally where our stance is. It's like 20 years time horizon is still plenty of time to grow that money. It should be working hard. And I think if you want some sort of like independent views on it, it's like you look at a lot of these life cycle products, or you look at a lot of model portfolios. I mean, to talk to Vanguard's life cycle product, they start shifting your asset allocation at 47.
Yeah.
And then it's like a slow shift as you get closer and closer to retirement. So I think the idea of being balanced at 46 is maybe a little too conservative, in my opinion.
Me too.
But look, Matt, I think I love the fact that you're investing equally as much into your super as your non-super. And I think that really opens up the conversation we want to talk about today, which is just how powerful making those additional contributions to your superannuation can be, because that tax benefit just compounds over time.
Yeah, so everyone has the ability to contribute up to their concessional cap, which is $30,000 a year. This is inclusive of contributions that your employer makes. So you might find after your employer makes their contributions across the year, they may have made a $20,000 contribution, $15,000, whatever it may be. The difference between that and $30,000 is your concessional is what you can add in concessional contributions. You can easily find out where you sit on that and how much you have left through MyGov ATO website to figure out how much left on your concessional contribution.
There are specific rules. The government really try and encourage you to make these concessional contributions. I think you can use the last 5 years of contributions.
If you haven't,
Yeah. So there are opportunities to play catch up if you want to play catch up. But look, I think the best way to illustrate this is with a worked example. Let's talk about the power of investing inside of super versus outside of super. So let's say you've got $10,000 a year to invest, an annual return of 8%.
Yep.
Tax rate within the super environment is 15%. So it's the concessional money you put in, but then also once it's in there, 15%.
Yep.
Great.
Yep.
And then in this scenario, I'm saying the tax rate outside of super is 37%. And so that's what you're getting paid.
Yep.
Like what you're investing, but then also let's say you're getting taxed on those earnings every year, just to really illustrate this point over time. So your contributions within super taxed at 15%, So your $10,000 turns into $8,500 invested. Then the earnings each year, we're taxing them as well, just to illustrate this point.
Yeah.
They're taxed at 15%. So your 8% return becomes 6.8%.
Okay.
30 years, almost $1 million, $962,000.
Nice.
Not bad.
That's pretty good.
That's pretty good.
Yeah.
At a 37% tax rate, so your $10,000 being invested each year turns into $6,300. So there's already a meaningful difference between the amount that you're investing, just because of that tax difference. But then every year, remember in this scenario, we're taxing the earnings every year as well to really accentuate the difference.
Yes.
8% return after tax becomes 5.04% return.
Wow.
And so you can see there that you're getting more, almost 1.8% less a year in returns.
Yeah.
And so after 30 years, 439,000.
Wow.
So it's a huge difference.
Yeah.
Now, realistically, when you're investing, you're not going to be getting taxed
Every year.
year because your capital gains grow and grow.
Yeah.
But I think it just really illustrates the point of any income you're getting paid is getting taxed at those marginal tax rates, and they do really compound and make a huge difference over a lifetime of investing.
Yeah. The biggest consideration, though, is the access to that. I think that when people are considering where should I go, because the numbers obviously point directly to superannuation. Like the best financial outcome is obviously super. But what we talk about a lot is when are you going to want access to your money? So if you're 20 years old, you're putting money away, you might think you want that at 40. Don't stop investing outside of super.
Well, in the spirit of having your cake and eating it too, if we go back to Matt's question, what he is doing is a great way to think about it. Yeah. So he's a little bit older, like 46. So he's obviously thinking more and more about the access to super is closer than what you were saying in your 20s. But putting half of his money into half of his investable money into super, half of his investable money into a portfolio of ETFs outside of super gives him a lot of flexibility.
Yeah, yeah.
And so I think, you don't have to go all in or all out.
No.
But I think just taking advantage of the free kick that's being offered to you.
Well, we've had multiple financial advisors on the show, and in most instances, they all say, try and get to your cap every year. It's a no-brainer.
Yeah.
Well, Ren, we only have a couple of weeks to go before the end of Super September, so I hope everyone is making the most of it, checking their superannuation, logging in, engaging with it, making sure that it is set up for the best way possible to maximize your outcome when you go to retire. And a huge thank you goes to our partner here at Equity Mates for Super September, Vanguard Super. You can head to vanguard.com.au/super to find out more about Vanguard Super. But Ren, that brings us to the end of our episode today. We'll pick it up next week.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.